You see the headlines, war in the Middle East. It feels thousands of miles away, right? Just another piece of news. But what if I told you that this distant conflict could be about to send a shockwave right through your stock portfolio? Today we're going to connect the dots and figure out exactly what this means for you.
The news is all about drones, missiles, and escalating tensions. But let's be honest, the real question that's probably flashing in your mind right now is my money safe? Should I be selling my stocks? We're going to cut through all that noise and get straight to answering that very question.
You know, the tremors from this are already being felt in markets all over the world. And in times like these, making knee-jerk reactions out of fear is, well, it's a recipe for disaster. So today, we're not just giving you some analysis. We are giving you an actual battle plan to help you navigate this uncertainty and protect your hard-earned money.
So how does a war so far away actually hit your wallet? Right here in India. The connection is incredibly direct, and it flows through one thing: crude oil. I want you to think of it as the main artery that connects Middle East geopolitics directly to the heartbeat of our stock market.
Now, have a look at these targets. This is what's so important to understand. This isn't just some random skirmish on a border. It's a calculated strategic attack on the world's energy supply chain. The drone strikes on oil zones, the attempted hits on Saudi Aramco, missiles aimed at Iraqi refineries. Each of these is designed to disrupt the flow of oil and cause maximum economic pain.
And what's the immediate result of all that? The market panics. Brent crude has just blasted past that crucial $90 mark. And listen, this isn't just a price update. This is a massive red flag for the global economy. It tells us that the risk of war is now officially being priced in, and that changes the entire game.
This chart just shows you how violent that reaction has been. I mean, just look at it. A month ago, oil was at $65. Last week, it hit 80, and today we're staring at 92. This kind of rapid climb isn't just a rally. It's basically a fever chart of geopolitical fear, and it is the single most important number driving the market right now.
But this oil price shock doesn't just happen in a bubble. Oh no, it triggers a powerful economic chain reaction, a ripple effect that spreads across the entire globe and eventually, you guessed it, lands right on Dowell Street.
So it's really crucial to understand how this works. It starts with the spike in oil. Now, since India imports over 85% of its oil, this directly fuels inflation right here at home. That forces the RBI and the US Fed to keep interest rates high to fight that inflation. Of course, higher rates slow down economic growth, which makes emerging markets like ours look a lot riskier. And what's the final step? Foreign investors start pulling their money out.
And who are these investors? They're the FIIs, foreign institutional investors. People call them the smart money because they manage billions and are super sensitive to global risk. The moment uncertainty spikes, their first move is to play it safe. That means selling assets in places like India and moving their cash somewhere less risky. Their selling is what can cause those sharp, scary drops in our markets.
Okay, so we've looked at the big picture. Now let's zoom in on our market here in India. Because you see, a high oil price doesn't hit every company in the same way. For some, it's a crisis, but for others, it's actually an opportunity. Let's break down the winners and the losers.
This table lays it out pretty clearly. The losers are the industries where oil is a huge cost. So you've got airlines, where higher fuel prices can just completely destroy their profits. You've got paint companies, because a lot of their raw materials are made from crude oil derivatives. Same thing for chemicals, tires, and even FMCG companies that have to pay more for packaging and transportation. But who's the clear winner? Well, it's the oil producers, like ONGC. For them, it's simple. They get to sell their product for a much higher price, which means windfall profits.
All right, so that's the diagnosis. Now, let's talk about the prescription. And honestly, this is the most important part. Your action plan. Because in a market like this, having knowledge without a strategy is completely useless. It is time to shift from just analyzing to actually taking action.
From right here, the market is basically at a fork in the road. Path number one is the bull case. Diplomacy works, things cool down, and oil prices drop back below $80. If that happens, you can expect a massive, powerful relief rally. But then there's path number two, the bear case. This is where the conflict gets wider. In that scenario, oil could spike past $110, which would probably trigger a global recession and a very deep correction. Your job isn't to predict which path we'll take, it's to be prepared for either one.
So, what should be on your dashboard? Here are 5 critical things to watch. First, Brent crude. If it stays above $100 for any length of time, that is a huge red flag. Second, the USD/INR rate. A rapidly weakening rupee is a crystal clear sign that money is leaving the country. Third, the daily FII data. Look for consistent, heavy selling day after day. Fourth, the India VIX, which is our market's fear gauge. A spike above 20 signals that panic is setting in. And finally, listen very closely to everything the RBI says. These are your early warning signals.
You know, in the middle of all this chaos, it's really important to just ground yourself with some timeless wisdom. As Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. A crisis like this is exactly what he was talking about. Panic selling is the enemy of building wealth. Patience is your greatest ally.
So, to wrap it all up, geopolitical uncertainty, it's a constant. You can't control it. But having a reactive, unplanned investment strategy, that's a choice. The path forward is to focus on what you can control. Watch the price of oil, understand your portfolio's specific risks, and most importantly, remain patient.
As always, this explainer is just for educational purposes. Please consult your own financial advisor before you make any investment decisions. And if you found this strategic breakdown valuable, do us a quick favor and hit that like button. It really helps the channel. And make sure you subscribe for more deep dives into what's really moving the markets. Stay smart and stay safe.